I'm recording this on Saturday, and by the time you see this on Monday morning, the markets might have already gapped. The United States and Israel just bombed an oil depot in Tehran. Not a military base, not a missile site, an oil depot. For the first time in this entire war, they targeted Iran's oil infrastructure. Flames and smoke rising over Tehran from two separate oil facilities. If you own gold or silver, you need to understand what this means because the market is going to open Monday morning with this priced in. I do not think most people are ready for what that looks like. Silver closed the week at 84.47, gold closed at 51.71, and crude oil just closed near $90 after pumping 16% on the last trading day. 16% in one session. Both gold and silver are sitting right at critical levels. Both are coiled, both are waiting. Crude oil is already screaming higher. And over the weekend, the war just escalated in a way that directly hits the oil market, which directly hits inflation, which directly hits the dollar, which directly hits gold and silver. Everything is connected, and I'm going to walk you through every single connection in this video. Welcome to the hidden economy. If you're new here, hit subscribe and smash that like button right now. I cover the data that mainstream finance ignores. You're in the right place. Let me give you the weekly picture first because the weekly close matters more than people think. Gold closed at 51.71, which is above the 5100 level. It was struggling with all week. That is a bullish weekly close. It means the buyers won the week. They defended the lows and pushed the price higher into the close. When you see a weekly candle that closes near its highs, it tells you the momentum going into the weekend is bullish. And bullish momentum going into a weekend where oil depots get bombed is a setup for a potentially massive Monday gap. Silver at 84.47 closed right below the 85 resistance I've been talking about. So close, it almost touched it. That tells me the pressure on 85 is building. The buyers are getting closer and closer to breaking through. They just couldn't quite do it before the Friday close. But with the oil depot news over the weekend, Monday might be the day 85 finally breaks, or it might be another rejection. And that binary outcome at 85 is what makes this the most important week for silver in months. But that's not the only emergency happening in silver right now. China just went nuclear on its own traders. And the COMEX numbers that came out this week are so alarming that I had to triple check them before I put them in this video. I'm going to show you all of it. The Iran oil strike, the China crackdown, and the COMEX data that nobody else is breaking down properly. At the end of this video, I'm going to connect all three and show you why they're pointing to the same conclusion. Stay until the end. Let me start with the COMEX data, because this is the foundation for understanding everything else. COMEX registered silver just dropped to 81.2 million ounces. Let me put that number in context. At the beginning of February, it was over 102 million ounces. In 5 weeks, registered silver has dropped over 20 million ounces. That's a 20% decline in deliverable silver in just over a month. The metal that is actually available for delivery when someone says, "I want my silver," is disappearing at a rate that I have never seen before. But here's where it gets scary. Pull up the open interest data. March 2026. COMEX silver open interest is sitting at over 58,000 contracts. Each contract is 5,000 ounces. Do that math. 58,000 times 5,000 equals 294 million ounces of silver that exist on paper. 294 million ounces of paper, claims against 81 million ounces of registered deliverable silver. That is a ratio of 3.6 to 1. For every ounce of real deliverable silver sitting in the COMEX vaults, there are 3.6 ounces of paper claims against it. Now think about what that means. If even a fraction of those paper holders decide they want their physical metal, the COMEX cannot deliver. The math does not work. 294 million ounces of demand against 81 million ounces of supply. The setup is a tinderbox, and the news about Iran's oil depot is the match. When the price of oil spikes, it drives inflation fears. When inflation fears spike, investors run to gold and silver. But what happens when they run to silver and discover there's not enough to go around? That's the question we might get an answer to this week. Now let's talk about China. This is the second piece of the puzzle. While the West is focused on Iran, China just made a move that has sent shockwaves through the physical metals market. They've launched a massive crackdown on speculative trading in their domestic commodity exchanges, specifically targeting silver. They are trying to cool down what they see as a speculative bubble. Why would they do that? Because they see what's coming. They understand that a global scramble for physical silver is on the horizon, and they are trying to get ahead of it by shaking out the weak hands in their own market. This crackdown has a dual effect. First, it temporarily suppresses the price on the Shanghai exchange, making it look like silver is weak. But second, and more importantly, it makes Chinese investors and institutions even more desperate to get their hands on physical metal held outside of China. They know their domestic paper market is being manipulated, so they're looking to secure real assets. This increases the demand pressure on global supplies, like the already draining COMEX vaults. China isn't trying to kill the silver market, they're trying to corner the physical supply before the rest of the world wakes up. So, let's put all three pieces together. First, you have the COMEX, with deliverable silver supplies plunging by 20% in a month, and a paper-to-physical ratio of nearly 4-to-1. The warehouse is almost empty. Second, you have a massive geopolitical escalation. The direct attack on Iran's oil infrastructure guarantees a spike in oil prices Monday morning. This isn't speculation, it's a certainty. That oil spike will light a fire under inflation fears, pushing investors towards safe havens. Third, you have China aggressively managing its domestic market, which signals they anticipate a global run on physical silver and are positioning themselves for it. Every one of these events on its own is a huge catalyst for gold and silver. But having all three happen over the course of one weekend? This is unprecedented. This isn't just another news cycle. This is a fundamental shift. We have a supply crisis, a demand shock, and a geopolitical accelerant all hitting the market at the exact same moment. The coiled springs in the gold and silver charts are about to be released. The key levels we've been watching for weeks are about to be tested with incredible force. So, what can you expect on Monday? A gap up in crude oil is almost a given. This will likely drag gold and silver higher with it. The big question for silver is whether it can finally break and hold above that critical $85 level. If it does, with this kind of volume and momentum, the path to 90 and beyond opens up very quickly. For gold, clearing the 5,100 level was the first step. Now it needs to push past its recent highs and show that this is not just another temporary spike. The connection is clear. War in the Middle East drives oil prices up. Higher oil means higher inflation. Higher inflation devalues the dollar. A devalued dollar makes gold and silver, which are priced in dollars, more valuable. They are the ultimate hedge against currency debasement and geopolitical chaos. What we are witnessing is the physical reality of the markets colliding with the paper fiction. The disconnect between paper claims and physical supply can only last for so long. A moment of reckoning is coming, and this weekend's events may have just lit the fuse. Be prepared for extreme volatility. The markets are going to be moving fast. Don't panic, but don't be complacent either. Understand the connections I've laid out for you today. This is the hidden economy at work, the real forces moving behind the headlines. Thanks for watching. If you got value from this breakdown, make sure you're subscribed and share this video with someone who needs to see it. I'll be back with updates as this situation develops. Stay safe and stay informed. That is not tight. That is broken. And the only thing keeping the system functioning right now is the assumption that most paper holders will never ask for delivery. They will settle in cash, they will roll their contracts, they will play the paper game. But what happens when that assumption breaks? What happens when enough people say, I do not want cash, I want metal? We are about to find out. Let me put this ratio in historical context, because I want you to understand how abnormal this is. During previous tight periods in the silver market, the ratio of paper claims to registered metal would get to maybe 2:1, and people would start getting nervous. 2.1 was considered dangerous. We are at 3.6.1. That is nearly double what the market considered the danger zone. And it is getting worse every week because registered silver keeps dropping, while open interest is not declining at the same rate. The gap is widening, not narrowing, widening. And here's what makes me lose sleep at night about this. The COMEX is a delivery market. That is its entire purpose. People buy contracts, and at expiration they can choose to take delivery of physical metal. The credibility of the entire exchange depends on its ability to deliver when asked. If the ratio gets extreme enough and enough participants lose confidence, that delivery can happen. The entire structure of the COMEX silver market comes into question. Not the price, the structure, the trust. And once trust in a market breaks, it does not come back easily. And it is getting worse by the day. This week alone, COMEX lost 3.2 million ounces of silver in a single day. 3.2 million. That is not a gradual drain. That is a hemorrhage. Eligible inventory, which is the silver that could potentially be moved to registered, is around 279 million ounces. But here is what most people do not understand. Much of that eligible silver is tied up. Banks hold it. ETFs hold it. It is being used as collateral for other instruments. Just because it is sitting in the vault does not mean it can be moved to the delivery pile. The actual freely available silver that could cover these contracts is a fraction of what the headline number suggests. Total COMEX silver stocks are around 371 million ounces and falling fast. But compare that to the paper demand of 294 million ounces in March alone. We are approaching a point where the paper claims on silver are getting dangerously close to the total amount of silver in the entire COMEX system. Not just registered, total. That has never happened before, and the rate of decline is accelerating. In my years covering this market, I have seen tight conditions. I have seen low inventories. But I have never seen a situation where the ratio of paper claims to deliverable metal is this extreme, while the vaults are draining this fast at the same time. Both things happening simultaneously, what makes this different from anything in recent history. Now, let me tell you what China just did, because this is the part that nobody in the Western media is covering, and I think it might be the most important development of the week. The Shanghai Futures Exchange just cracked down hard on its own traders. They issued an announcement citing Article 16 of their abnormal trading management rules. What happened is that multiple groups of accounts exceeded their daily position opening limits. In plain English, traders were taking on too many new silver positions too fast, and the exchange said no. They suspended the ability of these accounts to open new positions. Here are the numbers. In January, the SHFE suspended 40 groups of accounts. In February, 25 plus groups. In the first week of March, already 9 groups. And with Friday's volatility, there could be more suspensions coming. Monday, the SHFE is not playing around. Beijing is sending a very clear message. They do not want speculative frenzy in silver. They do not want coordinated plays. They do not want the kind of uncontrolled buying that could drain what little silver they have left. And let me remind you how little that is. The SHFE has 8 million ounces of silver in its vaults. 8 million. When I first reported this number a few videos ago, it was alarming. Now, with the exchange actively suspending traders to prevent error on that remaining inventory, it is beyond alarming. It is a crisis. The SHFE is essentially rationing access to silver positions because they know that if they let everyone trade freely, their remaining 8 million ounces would be gone in days, maybe hours. They are protecting the last drops of physical silver in their system by limiting who can buy. Now, think about what this tells you about the direction of physical metal flows globally. Silver has been flowing from the west to the east for months, from COMEX and LBMA vaults in New York and London to Shanghai and India. The premiums in Asia have been massive. Buyers in China and India have been willing to pay significantly above the COMEX price to get their hands on physical metal. That premium is what pulls metal eastward. And now the exchange on the receiving end of all those flows is saying we have 8 million ounces left and we are suspending traders who try to buy too aggressively. If China, with its massive industrial demand and its government-backed exchange, is struggling to keep silver in its vaults, what does that tell you about global silver availability? China is the world's largest consumer of industrial silver, solar panels, electronics, EVs, military applications. Their demand is not optional. It is structural. They need silver, and their exchange is running out of it, and they are suspending their own traders to slow the drain. That is not a market that is functioning normally. That is a market in crisis management mode. And here is the contrast that blows my mind. COMEX in the United States, which is also draining, has not taken any similar action. No position limits being enforced aggressively, no suspensions, no crackdown on speculative plays. COMEX is letting the market operate as if everything is normal, while the vaults drain 3.2 million ounces in a single day. 2 exchanges, both running low on silver. One is panicking and cracking down. The other is acting like nothing is wrong. The question you should be asking yourself is, which exchange has the right response, and what happens to the one that is not paying attention? Now, let me walk you through what happened with the Iran oil strike and why it matters for gold and silver specifically. On Saturday, U.S. and Israeli forces struck an oil depot in southern Tehran. IRNA, Iran's official news agency, confirmed it. A second oil depot in northwestern Tehran was also hit. An AFP journalist on the ground saw flames and smoke rising from the site. This is the first time in this entire war that they have targeted Iran's oil infrastructure. Up until now, the strikes were hitting military bases, missile sites, radar installations, naval facilities. The oil was left alone. That just changed. And this changes the entire equation for markets. Here's why. When the strikes were limited to military targets, the market could tell itself, okay, this is a military conflict. It will end when the military objectives are achieved. Oil infrastructure was off limits. That kept a ceiling on oil prices because traders assumed Iranian oil production would continue even during the war. That assumption just got blown up along with the depot. If Iranian oil infrastructure is now a target, the risk premium on oil goes up dramatically. Iran produces roughly 3.4 million barrels of oil per day. If their storage and refining capacity gets degraded, that production becomes harder to export even after the war ends. The Strait of Hormuz is already down 70%. Ships are not moving. 5 tankers have been damaged. Roughly 150 ships are stranded around the strait, and now the oil that was being stored for eventual shipment is literally on fire. The supply disruption just went from temporary to potentially structural. This war has now been going for over a week. The death toll in Iran has passed 1,300. The U.S. has struck nearly 2,000 targets. 11 Iranian warships have been destroyed. Qatar's LNG production has been halted after Iranian attacks on Ras Laffan. Saudi Arabia's Ras Tanura refinery was hit. And crude oil just closed the week near $90 a barrel. Let me say that again. $90. Crude oil pumped 16% on the last trading day of the week alone. 16% in one session. That is not a normal move in oil. That is a panic move. That is the market suddenly waking up to the fact that this war is no longer just a military operation. It is an energy war. And the oil depot bombing in Tehran on Saturday confirms that oil at $90 with depots burning is a setup for triple digits on Monday. And triple-digit oil changes the math on everything. Inflation, the Fed, the dollar, gold, silver, everything. And now oil depots in the capital city are burning. This is not a limited operation anymore. This is full-scale energy warfare. And the market is going to have to price that in on Monday morning with oil already at 90 after 16% single-day pump. And here's the chain reaction that gold and silver investors need to understand. Oil is at $90 and climbing. Higher oil means higher inflation. Higher inflation means the Fed cannot cut rates. Fed stuck at higher rates means the dollar stays strong. Dollar strong means gold and silver face headwinds in the short term from the dollar. But here's the twist. At some point, higher oil prices start breaking the economy. When gas hits or $6 a gallon, the American consumer stops spending. Business costs skyrocket. The economy weakens. And a weakening economy eventually forces the Fed to cut regardless of inflation. That is called stagflation. And stagflation is the single most bullish environment for gold and silver that exists. We saw it in the 1970s. Gold went from 35 to 850. Silver went from 2 to 50. That is what happens when the economy stagnates and inflation runs hot simultaneously. The oil depot bombing does not just affect oil. It accelerates the timeline for stagflation. It brings forward the moment where the Fed has to choose between fighting inflation and saving the economy. And when the Fed is forced to choose, gold and silver explode higher. Not slowly, violently. Because the market reprices decades of inflation expectations in a matter of weeks. And here's what I keep thinking about. The Fed's next rate decision is coming up on March 18th. 12 days from now, they were expected to hold rates steady. But if oil keeps surging because of the infrastructure bombing and inflation date on March 11th comes in hot, the Fed is going to be standing in front of the cameras, telling the country that they cannot cut rates while everything is getting more expensive. Gas, food, utilities, insurance, all of it going up. And the Fed saying, we cannot help. That is the moment where public confidence in the system starts cracking. And that crack is where gold and silver rush in. The 1970s proved it. When the public loses faith in the central bank's ability to manage the economy, hard assets become the only trust anchor. Gold went from 35 to 850 during that period. Silver went from 2 to 50. Not because people suddenly discovered gold, because people lost faith in paper. And we are entering the exact same psychological environment right now. War, inflation, central bank paralysis, and now direct attacks on energy infrastructure. The 1970s playbook is not a metaphor anymore. It is a roadmap. Now let me connect all three of these stories, because I promised you at the beginning that they all point to the same conclusion. COMEX has 81 million ounces of registered silver against 294 million ounces of paper claims. The ratio is 3.6.1. The vaults lost 3.2, so 2 million ounces in a single day. The system is under extreme stress. China has 8 million ounces left on the SHF and is actively suspending traders to prevent a run on inventory. Beijing is in crisis management mode for silver. And the United States just bombed Iran's oil infrastructure for the first time, escalating the war into energy warfare territory that directly impacts inflation, the dollar, and the macro environment for precious metals. All three of those stories are telling you the same thing. Physical silver is disappearing from the system. The authorities in China are panicking about it. The paper market is stretched to a breaking point, and the macro environment is about to get rocket fuel poured on it by an oil war that just entered a new phase. Here is what I think happens next. And I want to be clear. This is my analysis based on the data I just showed you. Monday morning, the gold market is going to gap. The oil depot bombing happened over the weekend when markets were closed. When the futures market opened Sunday evening, the first reaction is going to be oil higher, gold higher, silver higher. The question is whether the dollar also gaps higher and offsets the move in metals. That is the tug of war I have been showing you. War says gold up, dollar says gold down. And right now, the oil strike gives the war side a much bigger weapon than it had before. But I want to be honest about something. We have seen this movie before during this conflict. Monday of last week, gold gapped up to $5,400 and then crashed $400 when the dollar surged. The market has a way of doing the opposite of what everyone expects on the open and then reversing violently. So, while my instinct says gold and silver open higher on the oil news, I'm also prepared for the possibility that the dollar surges on safe haven flows and caps the metals move. That is the reality of trading in a war. Nothing follows the textbook. Everything is headline driven and the headlines change by the hour. What I am watching specifically is the $85 level on silver. If silver gaps above 85 on Monday morning and holds above it for the session, that is the breakout from the cap I have been talking about. That would change the entire short-term picture. But if silver gaps above 85 and then gets rejected again, that tells you the cap is still in place and the big players are using the gap as an opportunity to sell into the panic buying. Watch 85. That is the tell. But beyond Monday, the bigger picture is this. The COMEX silver market is trading on borrowed time. 294 million ounces of paper against 81 million of real metal is not sustainable. The SHFE with 8 million ounces and active trader suspensions is not sustainable. And a war that is now targeting oil infrastructure is not going to cool inflation. It is going to accelerate it. I sat with this data all weekend. The COMEX numbers, the SHF crackdown notices, the oil depot footage from Tehran, and the conclusion I keep coming back to is that the silver market right now is like a pressure cooker with every valve being tightened at the same time. The physical supply is shrinking, the paper claims are growing, the exchanges are restricting trading to slow the drain, and the macro environment is about to get the most inflationary catalyst we have seen since the war started. Every one of these forces is building pressure, and pressure cookers do not gradually release, they blow. I'm not predicting when, I'm not predicting a price. I'm showing you the data. 3.6 ounces of paper for every 1 ounce of real metal, 8 million ounces left in Shanghai, 40 plus groups of traders suspended in 60 days, 3.2 million ounces disappearing in a single day, and oil depots burning in Tehran on a Saturday night. You can draw your own conclusions, but the data has never been louder than it is right now. I have been covering gold and silver for a while, and I want to be real with you for a second. There have been times when I looked at the data and thought, okay, this is interesting, but it is not urgent. This is not one of those times. The combination of what I am seeing in the vault numbers, the exchange crackdowns, the paper to physical ratio, and the war escalation into energy infrastructure is unlike anything I have covered before. Every data point individually would be a significant story. All of them happening at the same time in the same week is something I did not think I would see. And the fact that it is happening while silver sits at $84, right below the 85 cap, with the entire market coiled, and waiting for Monday morning makes this the most consequential weekend for precious metals in years. The question for this market is not whether the paper price reflects reality. We already know it does not. $84 with this kind of supply stress is a price that only makes sense in a paper market where most participants never take delivery. The question is, what happens when enough participants start demanding physical, and the paper market collides with the physical reality that there is simply not enough metal to go around? That collision is getting closer every single day. Every day the vaults drain. Every day the SHFE suspends more traders. Every day the paper to physical ratio gets more extreme. The market can stay irrational longer than you think, but the math cannot be argued with forever. And the math right now says this system is breaking. Drop a comment. Tell me what you think happens Monday morning. Tell me if you think the oil depot bombing changes everything, or if the market shrugs it off. Tell me if you think 85 breaks this week or the cap holds. I want to hear your analysis. I will pin the best ones. Share this video right now. The COMEX ratio of 294 to 81 is something that every silver investor needs to see. The China crackdown data is something nobody in the Western media is covering, and the oil depot strike just happened hours ago. Help me get this in front of the people who need to see it before Monday morning. If you're new here, hit subscribe. I cover COMEX, data, vault drains, exchange crackdowns, and the war's impact on precious metals in a way that nobody else is putting together. Links in the description. This is the hidden economy. COMEX registered silver at 81 million ounces. Paper claims at 294 million. Ratio 3.6.1 and widening. China suspending traders to protect 8 million ounces. COMEX losing 3.2 million in a single day. Oil depots burning in tan. War entering energy warfare phase. Stagflation timeline accelerating. Fed decision March 18th. CPI data March 11th. Silver sitting at 84.47, 53 cents below the 85 cap. And Monday morning is 12 hours away. The pressure cooker is full. Every valve is tightening. And watch 85 on silver. Watch the dollar on the open. And watch the oil price, because what happened in Tehran this weekend just changed the math on everything. Follow the data, not the noise. I will see you tomorrow.